Live. That nice big desk. Hey, good afternoon, everyone. Thanks for joining us. We'll get started here in just a few minutes. Just a few minutes. Thank you for signing on. Hey, everyone. Where are you guys watching from? I always want to know where you're signing in from. What's up, Byron? Good afternoon. Is that lighting better? Oh, the lighting's a little better. I guess this could be our last Corona update, huh? Call it market update. Joe, how's it going? Renee, my driveway. That's funny. Kentucky, that's great. Nice. Hopefully, everyone had a great weekend.
Rob, I didn't have the best weekend. I got Friday.
Too much enough. I saw you go out for a little Sunday afternoon drive, though, Mr. President. That was very nice. In your tank. All right, let's get rolling this. Hey, as always, we want to thank you and appreciate you guys for joining us. Just note, this is not an offer of securities, even though that's what our marketing department has been focusing on all morning long, trying to get some stuff cleaned up. Today, this afternoon, we're going to go over some market stuff. We might be talking about syndications. We might be talking about crowdfunding. We might be talking about tenants in common, joint tenants. We might be talking about first position loans, second position loans, unsecured loans, all that good stuff that makes Mr. Texas Real Estate unique and exciting. But I can assure you we're not soliciting you for any of that. We're just talking about it for education and demonstrations and sometimes entertainment purposes only. Help us ring the bell. I see a couple of you guys are on Facebook. We do appreciate you guys following us, but we're moving more and more towards YouTube these days. Very exciting time for us. Our studio's almost set up. Like we're almost real YouTubers, Jason. So that's check out our channel, Texas Real Estate Radio Network. Go over there, subscribe, and ring the bell so you notifications. We're broadcasting live there too. As real YouTubers do, we have a Patreon account. So check out our Patreon account at www.patreon.com/MRTXRE. Check that out. We have some specials that we're doing. There's a $10 level, $15 level, $25. This is it. Now, we might do a $50 level about expanding your business, but right now, $10, $15, $25. Everyone who's joined up so far, we want to thank all of our Patreon members. Thank you very, very much for your support. Everyone has signed up at the $25 level, so I think it's time to probably drop the $10 level, Jason.
You know what? Leave them on there just in case.
Man, we'll do a fourth, though, pretty soon. But for $25 a month, so what we've done is obviously we can't have live events. We used to do almost a class every Saturday when we were with the Keller Williams there, and we would use their room, and we'd always get like 10 to 15 people showing up on a Saturday class for, I don't know, $20, $40, whatever it was. and we give a lot of knowledge bombs, and we miss it, but we don't miss it so much that we really want to give up our Saturdays anymore. So what we've done is we've just taken those videos and we've put them all out there onto our Patreon account. So every month we drop a couple new videos for you guys to be excited about. We also do we used to also do a free Ask Mr. Texas Real Estate. It's now going to be exclusive for our Patreon Platinum members only, and then of course the videos will be shared later. So we'd like you to take a look at that, consider that, give us a little support. What we're trying to do is just get our marketing covered, just get A-Rock's pay, his check covered every month. This is not a profit center for us, but if you like what we say and what we have to share, I know that Jason's
going to keep our people employed.
Yeah, we got to keep some more people employed. Yep. Jason started his property hunt. This is for Mastermind members only. So we went out and looked at 5 properties that all take them all down, $400,000 for everything, property rehab, little cleanup, and you're going to have close to $5,000 a month in growth rent. So, I mean, that's a solid number right there. That's a very, very, very solid number. So we're looking at that and thinking, hey, it's going to be X blah 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 blah. 40,000 divided by 60,000. We're at 1.33 DSCR on that. So the first week of Jason's October property hunt. By the way, you got that tonight too. Don't forget, Jason. The people who signed up with our mastermind or joined it. It's awesome. The property hunt is underway. We did 5 properties. They're all going to be perfect for landlords. And so if you want to get involved, join our mastermind. It's Monday nights actually at 7. Here's the cost to join the mastermind. We don't huddle anything back. It's $10,000 year 1, $7,500 year 2, $5,000 year 3, and $2,500 year 4 free thereafter. It's really for high net worth individuals, those making 6 figures or more, 700 general FICO, and access to capital. We talked about it on the radio this morning. We said, hey, if you're one of these people and you haven't started diversifying your retirement portfolio with real estate, then you're missing the boat. There's no better time. And there's a lot of you out there I know watch the show, watch us, believe what we do. We've always been looking for a time. I can tell you now is the absolute best time to get involved in this. So if you want to learn more about the mastermind, 281-401-9008. We'll do a follow-up call. We had 3 people join in September. We'll probably bring in 3 to 5 in October because this is the optimum time to buy property. It's going to be a good fit. You want to be around that are actually doing it. We build a real 5 to 7 year plan for you. Part of our community. Our building is over here on Hollister. We're very protective of our group. We got tons of gurus that want to present, and we're like, no, that's not going to happen. And we keep it to about 50 people a year. And when we make mistakes, we admit it. We pivot. We just let our group know that we're switching out of a property management company, all these reasons, and just kind of give them the heads up to make their own decisions. But, we're going to provide that information for them. And then there's none of this seniority stuff. I don't even understand how these other clubs work with these apartments and all this other stuff. It doesn't make any sense to me. But we don't do it. We just want you all to be massively successful. So whether it's small apartments or storage units or Airbnb or regular single family that does very, very nicely in this market, we want to provide support and the help and the network for you guys to succeed. So that's the mastermind. Last thing is Ambit Energy, and we talked about that last week. If you haven't checked that out, make sure you check it out. But join our platform. So we have an investment platform. We have ways for you guys to qualify yourself. If you want to talk to Brian, you must self-qualify to be on the platform, right? So you've got to let us know that you're a real investor, that you're not a newbie, that you understand the risk involved, and you get to kind of see the deals we're working on. We've got 2 new deals going up this week. We're very excited about. Small little one. Just, hey, we need to raise $500,000. And we're doing it $50,000 at a minimum investment. and we'll probably get 6 or 7 people just take the whole thing down, and it'll be gone in about 10 days. So, the things come up, they come down. It's always kind of active. We'd love for you to get access to our platform. You're going to basically reach out to Brian. He'll hook you up. You can text him again at 281-401-9008. Text Brian or text Invest or text Platform. We're good to go. All right.
Okay.
Jason, are you ready?
Yes, let's see here. All right. Can you guys see my screen yet? Rob?
Yeah, I got to go boot it back.
Oh, looky there. All right, guys. Instead of the usual 100 different articles today, we're going to go over this one single article. This is one of the best articles I've read in 2020 because it's right. Visualizing the U.S. housing frenzy in 34 charts. Yes, we're going to go through a couple of these charts, and I am going to read some sections of this. There's not a whole lot in here, but I want to get into the charts pretty quickly. While the Fed was fully aware of its actions in March when it launched unlimited quantitative easing and started purchasing corporate bonds and ETFs would result in an already massive bond and credit bubble becoming bigger than ever. It probably did not anticipate that this would be accompanied by another epic housing bubble to boot. This is correct. I wouldn't call what we're experiencing now a, quote, housing bubble. However, the first 3 lines of that paragraph are absolutely 100% correct. Unlimited quantitative easing has allowed corporate bonds and ETFs to absolutely explode. That's one of the reasons why you're seeing all this action on the stock market. After briefly slowing down in the second quarter, the plunge in mortgage rates to record lows, exodus from urban rental units to suburban single-family houses has unleashed a home buying frenzy, with national house prices rapidly accelerating in the third quarter, with the Case-Shiller and FHFA house price indices pointing to 8 to 13% annualized month-over-month growth. That is insane. And as they point here, that's 5 to 8 times more than the average wage growth. This is right here. This is probably the most important paragraph in the whole article. As a recent analysis by Goldman's housing team shows, price growth remains strongest in relatively affordable markets. I want to say that again. Price growth remains strongest in relatively affordable markets. Let me switch some words up on you here. Price growth remains strongest in Texas. Probably what that should say. The highest markets obviously are Phoenix, Charlotte, and Tampa. Lower price tier homes continue to outperform on the back of robust demand and constrained supply of what? Affordable homes. This is all what we predicted a little over 2 years ago. It's all coming into fruition. Now, here's what makes this. We knew all this the first couple of lines, a big long sentence there. We knew all that. Here's where things get crazy. Paradoxically, the upward acceleration in home prices is not being driven by loosening lending standards. On the contrary, average FICO scores for purchase originations are up, and average loan to value and DTI ratios are down year over year. So we have a shrinking supply, robust demand, and those people that are buying houses are more qualified than they were a year ago. And they have higher loan to value and lower DTI ratios. That's crazy. That means these properties have equity in them. The borrowers have they're much more robust, meaning they have less debt and higher FICO scores. And I'm going to show that to you here. This is the most important paragraph. Heck, you could. I could have written this. Well, I could have written this first part for you 2 years ago, but this last part nobody predicted, which is incredible. So let's take a look at some charts. Everyone is worried about housing affordability. There's your housing affordability index. The higher that line is, the more affordable the houses are. What do you see? By the way, this chart goes all the way back to 1991. This is today in 2020. Houses have never been more affordable, according to the index. This is rent ratio stuff. I really don't want to go over that. This is the housing tracker, and this is what they call price diffusion amongst zip codes, meaning almost 100% of zip codes have experienced positive growth. So the whole country is actually in a giant rebound. But this is the most important chart in this set of charts. Houses are wildly affordable nationally. I think that's changing quite quickly here in Texas, but nationally they're quite affordable. All right, let me scroll. Okay, that's affordability. This is housing starts. And if you guys have been following me for any length of time, one of the things I've said is construction has not returned since 2008. That is still the case. One of the things that led to the housing crash, and I'll tell you the best book that was written on the housing crash is the one that Aaron Clarey wrote called Confessions from an Insider, how the housing crash occurred or developed, something like that. Let me pull up this book real quick. I want to make sure I get the name right. Yeah, here we go. Behind the Housing Crash, Confessions from an Insider. Aaron, I should be on Aaron's payroll at this point. I've recommended this book so many times. It is an excellent book. One of the things that he says in the book is we were overhoused, which is absolutely true. We had built all these homes, a few million homes a year, which we really didn't need. And you can see we've not even come back to 2000. This is 2020. This is year 2000. We're not even back to building homes back from at that level. That's more housing starts. This is pending and existing home sales. Now, why is this number important for you guys? As real estate investors, when you dispose, aka sell your single family house, it's going to be as an existing home. So you can see here, existing home sales. The report last week actually said they've never been higher. So that's 20 years worth of data. This is the purchase sentiment index. It's kind of like, hey, is it a good time to buy a house? What's the consumer market believe? Now, this is where things get really interesting because we've got this ramp up in demand. And the question is, what do our supply levels look like? This is incredible. So this is the last 4 years. Inventory of homes available for sale. The watermark is January 2017. That number equals 100. This is an index. We are at 80, meaning we are 20% below January 2017 at the index at 100. If you look at it in time, in real time, we're actually, that's about 115? That's 80. We're 35% below where we've been in the last couple of years in supply. We just don't have any homes to sell. This is the share of number of homes sold in 2 weeks or less. Look at this. This is insanity here. That is a almost 20% delta. Absolutely incredible. Single family homes available for sale, seasonally adjusted, you can see is completely collapsed. That chart goes all the way back to 1990. That's 30 years worth of data. We don't have enough homes to sell. There's just nothing to sell. So prices are going to respond pretty soon here. This is months of supply. This is a popular metric that is used in real estate. This is national data. We are at about 3 months of inventory, which is insanely low. A normal market is about 6 months of inventory, meaning we have to double the amount of inventory or the demand has to fall in half in order for us to get back to a normal market. We need a real estate crash to get back to a normal market. Absolutely bananas. Absolutely bananas. All right, let's talk about mortgage lending standards. Jason, who's buying all these homes? This is an index that tracks tightening or easing of mortgage standards. The higher the number, the tighter it is, the harder it is to get a loan. The lower the number, the easier it is. Obviously, after the crash in 2007, it was really hard to get a loan. Well, now look at this. It's becoming harder and harder for your average homeowner to get a home loan. That's a credit index. Nobody cares about that. Here's what's interesting. Rob, you're going to love this one. Average FICO at origination for purchase mortgages. People buying homes. Blue is the GSEs. That's your Fannie, Freddie loan. GSE is government-sponsored entity. FHA and VA is the light blue. You can see here coming out of 2005, the average was about 730. Down here for FHA was about 650. And now look, since 2009, 2010, the average has been almost 700 for your FHA, VA, and for your GSE loan, it's 730. Oh, 750. And you can see here, 760 and almost 700. It is really hard to get a loan. If you do not have a beautiful FICO score and a low DTI, you're just not going to get a loan. In fact, let's take a look at this. Share of loans with DTI above 43% for purchase mortgage by origination date. And you can see that has rapidly collapsed over the last 6 or so months. So these borrowers are just better prepared financially to buy a home. I don't want to get into rental vacancy stuff. I think there's a lot of, how can I put this? There's a lot of noise in these numbers because of the moratorium on evictions. So I don't think that's really helpful. This certainly is. This is median price of new and existing single-family home sales. You can see that here. This is one of the things that we had talked about. This gap was eventually going to start to collapse. It's almost $320,000. That's the median home price in the United States. This is some more price rise metrics. There's some really interesting data coming out regarding some of these rise in prices. I'm looking for, this is all coronavirus stuff. I'm actually looking for some of our FICO data. Oh, I may have passed it. Here we go. This is where it gets really interesting. So the strongest house price growth is in the South, period. I believe they actually pulled this data from Case-Shiller. Houston is not a part of Case-Shiller, but Dallas is. You can see Dallas down here. What's fascinating is, and I want you guys to see this. Here's serious delinquent mortgages. Here's the unemployment rate. Here's what they actually call the vacancy rate. And then here's what's fascinating. Average FICO for purchases by city. The lowest one on here is 718. So if you've got a credit score below 718, it's gonna be tough to get a mortgage. It just is. The highest on here is 760, and that's San Francisco. So you're gonna have to be in the 700s. Now, what's interesting is, this is one of the things that we tell guys. We're like, look, you wanna join our mastermind? Great, but here's the deal. Do you have a credit score of at least 700? If you don't have a credit score of at least 700, it's hard for you to buy a single family house to live in, let alone to use your credit to buy a single family investment property. It's just gonna be really hard. If you have a 600, 620, 650, it's just gonna be almost impossible to get a single family house unless you buy it sub 2. So keep this in mind. This is even in some of these really rough markets. I mean, look at Miami, Las Vegas. So Vegas is a market Rob and I really want to buy in. And unemployment rate is 16%, but you still got to have a 730 to qualify for a mortgage. So what's going to happen? You've got this marketplace that has massive unemployment that is getting just obliterated right now, and those credit scores are dropping. So what's going to happen? If nobody can get a loan to go buy a house, the prices of the homes are actually going to decline. We're starting to see that in the condo market in Vegas. Miami is just above it with 13% unemployment. They're down to a 718. So very interesting data that is coming out of a lot of these different places where we can track the borrowers and the assets. This is number of borrowers in forbearance plans. You can see that's already tapering off. Percent of mortgages with negative equity, that has collapsed. Fewer than 4% of mortgage properties have negative equity, down from 25% in 2011. It's absolutely insane how much more equity people have in their homes. This is one of the reasons why the refinance market has exploded. There's all these folks with all this equity in these houses, and they're refinancing them. But what's amazing is they're not taking any cash out. So they're leaving a ton of equity in here. I mean, to go from 25% of homes that had negative equity in 2011 in 9 years to 5% or fewer than 4% is absolutely incredible. Oh, here we go. I thought this one would be in here. Cash out refi share and cash out dollar volume by origination. It's just amazing how few cash outs that we're doing anymore. Total dollars of home equity cashed out is on the right, and then this is the number of refis. On the top, and then this is the one that's on the bottom. So when they're refining, they're just refining the rate and the term. Household and stock market equity held by households is at an all-time high. This is 20 years worth of data. So when I hear people, the crash bros out there, Jason, there's a big crash coming, crash coming. I'm like, how? Explain to me how the crash is actually going to happen. Because we got a lot of people have a lot of equity in the homes. The people that are buying homes are high-quality borrowers. Explain to me how a crash happens. Explain it to me. Well, Jason, prices are rising. Yes, prices are rising. How does that equal a crash? Explain me. No one has been able to explain with any data other than being provocative on YouTube, creating more clickbait, that there's a crash coming. I'm just not seeing it. I'm seeing some sub-markets that are going to have some problems. Vegas is going to have a huge problem this year. Nobody's going to Vegas. Well, Brian and I and Rob, we're all going to Vegas at some point here this year. But no one's really going to Vegas. It's a huge problem. That market is heavily impacted by travel. I'm looking for another chart I can bring up here. Where's the here's our affordable. Well, Jason, houses are no longer affordable. I'm like, affordable for who? People in forbearance plans. Well, that's already tapering off. And heck, the president tweeted from his bed at Walter Reed this weekend that they want another stimulus package, another $2 trillion. And I'm like, for who? Like, who needs $2 trillion at this point? I guess the voters do because we're getting close to the election. But another $2 trillion, we've spent $6 since the coronavirus. I don't see why we need more money. It's not making any sense to me. So if you're waiting for the next crash, it's just not going to happen. There's no crash coming. You're going to sit around and wait nearly 10 years for the next crash. So if you are on the fence about getting in and starting to invest in some real estate, you can get off that fence now. Because you're either going to do it now or it's never going to happen. Like, I can almost guarantee you, if you're not going to start buying real estate, investing in real estate here in the next 12 to 18 months, the likelihood is you're never going to do it because now is never going to be a better time. There's never going to be a better time than now. I mean, it's just absolutely incredible time to get into real estate. Now, are you going to be able to invest in real estate 10 years from now? Sure. But this is a really sweet place to be. So, Rob, that's all I got. I don't see any questions here other than this weird message we got in the chat. So, But you got anything else? No? I just heard Rob scream from the other room. No? All right. Well, that's all I got today, guys. Unless, Rob, you got anything else, I'm going to go ahead and close this thing down. We're going to go to lunch. And
Yeah, I definitely need a little lunch doing this rough day here. But, yeah, no, we're all good. We talked about the mastermind. Folks, take a look at it. Best time right now. Let's get going. So we're here, 281-401-9008. Thanks for joining.